I'm
and
gonna record
still,
this. Sorry.
okay.
Yeah. No,
Yeah.
no, keep
So,
going. I was gonna say we see a lot of leases happening. And so I was
yeah.
wondering too, obviously the rates changing, that affects residential. How does that, I guess we might as well just start with that. How are the rates for commercial with the feds doing what they did? How does that affect you guys? And I definitely think people are probably leasing over purchase and right now. But
Yeah, since we're on that,
yeah,
I'll just
yeah,
touch on it. And then if you want to move into, I
the
do have
loans.
a
Yeah.
presentation that
Awesome.
we can
Yeah,
follow,
yeah,
or we can just
yeah,
whichever
yeah.
works for the group. So as it relates to the interest rates and what I started seeing happening last year is so many projects, and by project I'm referring to the purchase, the acquisition of real estate, didn't pencil out anymore because of the increase in interest rates and other nuances. Certainly, the value for property was really at a peak last
Mhm.
year. And so now, this year, as we're entering almost into fourth quarter, we're starting to see some things pencil out a little bit better with the interest rate decrease last week. It didn't shift the interest rates all that much because we
Yeah,
normally follow the 5-year treasury, 10-year treasury, et cetera. They had already kind of had that potential decrease baked in. So for probably 6 to 8 weeks prior, I saw a decrease in the 5-year treasury, which is what I follow every day. So that things started penciling out and
yeah.
opportunities seem to make more sense. So that's where I'm hopeful we'll be heading into the months to come.
So do you think, well, how much does the election weigh on you guys? I know and it's been proven, I've seen it
Mm-hmm.
doesn't matter who's elected. It truly doesn't matter, but in people's minds, they halt everything because of
Yep.
it. So
Yep.
commercials, do you think it's even more impacted just from a business standpoint?
It's possible to say that it might be more impacted. So at the beginning of the year and even late last year, as we knew 2024 would be an election year, I would hear some business owners saying, any election year, we generally predict stagnant growth,
Hmm.
just really stable. We don't predict a lot of heavy investment in our business during that year because things tend to stall. People tend to have the mindset of let's just hold tight for right now and see what happens.
Yeah.
But back to your point that you made, whoever is elected generally doesn't make a significant
No,
shift in things. It just
no.
causes people to think there's an election year. I'm going to hold
Right.
tight and
Yeah.
see what happens. And then it happens and like everything's okay.
Yeah.
Let's move forward.
Correct. Yeah.
Yeah.
Policy doesn't change overnight. It
No,
never has. So,
no.
I mean, well, let's get into your presentation.
Okay.
I'm really excited and appreciate you taking time out. So we record this so that because we have agents in other states too, and if they have another job or agents that are onboarding, they can watch this.
Oh,
So
wonderful. Well,
yeah,
I certainly
yeah,
hope to provide some insight into my
yeah.
everyday world of commercial lending. Um, Bear with me. I am not tech savvy, but I
You're
do
fine.
have a presentation. So if I
Oh
just
yeah,
click share,
let me make
okay.
you host. So I believe that's what I have to do. Okay. Now you can share. It's all
Okay.
you.
Let's see if I can do this.
Okay, we
Okay,
see it.
good deal. And
Awesome.
I'm just going to click on that. So we're still good?
Yep. Yep.
Excellent. Well, good. Well, Mara, I really appreciate the opportunity to spend some time with you and your agents to share a little bit about commercial real estate lending. Um, I'll first share a little bit about myself. My name is Christy Botain. I'm a senior vice president and commercial loan officer with Meadows Bank. We are a regional community bank. We're headquartered in Las Vegas, and we have one branch here in Arizona. It's at Camelback and 22nd in Phoenix. But I myself am a commercial lender, so I really cover primarily Maricopa County, primarily the Phoenix metro area, and then even more localized, primarily the East Valley. But I'm having conversations with people all over the valley to help them. I really focus on working with business owners. Um, I've been in banking and finance for 30 years. I go all the way back to college when I got a first job as a teller at a community bank back in Minnesota. And I've grown in my career to include credit analysis work, a lot of underwriting. And I got my first start with a national bank in Fargo, North Dakota as a business banker. And so that was my first foray into really the face-to-face opportunities that I've been able to build with business owners over the years. Additionally, I've worked with community banks, I've worked with national banks, and my focus has really been driven towards the values that I have, and the community banking space fits those values. It's really about doing what's right for the community, about helping the small business owner, because it's a belief that I have that when our small business owners are successful, then our communities thrive. That's kind of the core of why I do what I do every day. I primarily focus on conventional lending. So in my world of commercial real estate lending, there's usually two options that rise to the surface right away when I have conversations. The first option is a conventional bank loan. I'll go into some details about what that means. Additionally, the alternative is typically an SBA loan, be it an SBA 504 loan or a 7A loan. But what I do every day is conventional lending, so I'm probably going to gravitate towards that a little bit. I will touch on some of the SBA lending criteria and details. And additionally, with my approach with working with small business owners or individuals who are looking at investment real estate, is I have what's called kind of a cradle to grave approach. So what I do is I go out and I find the opportunity, I connect with the business owner, I connect with the investor, I create the opportunity so that if they are looking for a loan, if I've earned the right to help them with that loan, I will go through everything from gathering the information, underwriting, doing the financial analysis, working through the closing of the loan. And then once it's a funded loan, actually managing that relationship going forward. And I'll also touch a little bit about my history as well. I was born and raised in Minnesota. I came here on vacation in 2015. It happened to be during the month of March. And I fell in love with Arizona. I fell in love with the beauty. Certainly the sunshine and warm weather compared to Minnesota was advantageous. And so my husband and I, with our two small children at that time, ended up moving here in 2016. So I've been in the East Valley. I've been in Gilbert since that time. I've built my network from scratch. I didn't know anybody out here. I'm heavily involved with the Gilbert Chamber of Commerce and other organizations that we support. And my husband and I will actually celebrate 25 years of marriage tomorrow. So I'm super excited about that. Our two young children are no longer young. My daughter is 20 years old and she's in her second year at Chandler Gilbert Community College. And my son is a senior in high school. And he's also doing part-time at EVIT on the Power Campus. So a lot to be thankful for and blessed with, but just wanted to share a little bit about my history with you. So getting into commercial real estate lending, what I wanted to touch on and what I hope to do is, at least from your perspective, kind of what you are faced with in your opportunities that get presented with your clients. If they're looking for commercial real estate, if they've already found that perfect property, kind of what are the next steps that are involved as it relates to finding the right financing for that. So in this example, you've got your client. They may or may not have found that perfect spot, but hopefully you're getting close to finding that real estate that they want to purchase and acquire. So a question at some point you will likely ask is, have you talked to your bank? And I know that residential real estate compared to commercial real estate, there are similarities, but there are also differences, not only in the process, but also kind of what's involved. So although the steps are similar, be it the underwriting for a real estate loan or getting an appraisal or working with a title company, the order of those processes might be a little different. Additionally, it's probably a longer process on a commercial real estate loan compared to a residential real estate loan.
What are some timelines that you've seen? And they also, I know, can get extended too based
Yeah.
on as you start getting into it.
So one thing that I like to do in the preliminary process, which I'll touch on as well, is I like to educate the customer on that timeline and what they can expect in the process. Generally speaking, what I usually share is best case scenario. Once you have a purchase agreement, you've started or you're well into the process of underwriting with a bank, I usually recommend about a 60-day time frame. A more realistic time frame is usually 90 days. Although somebody might encounter a bank that says, I can get your commercial real estate loan done in 30 days, that's extremely rare. There are so many parties involved in the process. There's a lot of in-depth detail involved in the process that I usually recommend 60 to 90 days on average. If we're talking about an SBA loan, that could be similar, but it could also be a little bit longer as well. So that might be a good guide from a time frame perspective. So if your client has talked to a bank, hopefully they have a general idea of what they might qualify for. If they haven't, they probably have a little bit of extra legwork to do to get that qualification. So I think that the term pre-qualification can correlate on the commercial lending side to what I call a term sheet. So I'll go into a little bit of detail on what that term sheet involves, but really important is for that client of yours to at least have a relationship with a bank or have talked to a bank. If they haven't, that's okay too. You kind of move through the process as it suits their needs.
Do you, I find, and maybe this is from my residential, I mean, honestly, I would have my client talk to a bank so that we know kind of what their plans are. Because sometimes you guys, okay, they can afford this, but Mara, really, you need to look for a property in this scope based on what they're trying to do business wise and for their loan. Otherwise, we can't loan on that property. And so I feel like it's kind of like before, and then we're looking at properties. Is that correct? And then, you still make sure that your contract is
Yeah.
within the timeline that you need, right?
Yeah. The best path to success is definitely having them talk to a bank or their banker before. Having that general idea. I've had lots of conversations with individuals. As an example, they're currently renting space. They're a year, maybe even 2 years out from the maturity of their lease agreement, and they're considering buying real estate, and they really don't know, would they qualify or not? I personally love those types of conversations. I hope my counterparts in other banks do as well, because you're better able to set the stage for success in that future goal by spending the time talking to a banker about what will it take. Excuse me. And so in those conversations, what I get to do is I get to do some financial analysis. We get to have a conversation about what dollar amount or what potential purchase price range would they qualify for, so that they have a better idea of what types of properties they can go out and look for. Does that kind of help? Yeah. So this is kind of just a real basic summary of what a bank will ask for at that preliminary conversation. It does include information that will go into formal underwriting, and I'll talk about that a little bit later. But this is really the basic foundation. So when I get a call from somebody and they say, hey, I'm looking at buying property and I'd like to get a pre-qualification, I'd like to know what I might be able to look for. What I'm doing is gathering this basic information on the front end. So I'm gathering 3 years of historical financial information, current personal financial information, as well as, if they do have a property in mind, any information that might be available. But at this stage, I don't have to have that detail. I can get a term sheet issued with just some basic financial information. And as I mentioned, it's really the best path to success is having that well-established relationship with a bank where they know the business, they know the owner, they've had conversations about the goals. They might even be really familiar with the financial performance of the business. And I know that there's another part that we'll talk about is that individual who's just looking at investment real estate. It's similar yet slightly different. In the majority of my conversations, it's usually a business owner that's looking to expand their business into either new property that they own or a larger property that they might need. So when I get those phone calls, I mentioned before, I primarily do conventional real estate lending, and there's also SBA lending. There's a couple of questions that really drive me to figure out which might be the best pathway. It usually starts with finding out how much they want to put down on the purchase. So their equity position. If they don't have a lot of money, if it's nominal, I usually steer them towards the SBA route. The SBA structure, generally speaking, is going to look like a 90% loan to value loan amount, and that would require 10% equity down from the business owner, the borrower. So that's the general type of loan to value structure for an SBA loan, and that includes both a 504 and a 7A. On the conventional loan side, if we're looking at an owner occupied property, my loan to values generally range from 70% to 80% loan to value. If it's an investment property, that dips a little bit more into the 50 to 60, maybe max 70% loan to value. There's reasons for those loan to values that we have. I'll give you two examples. For an owner occupied property, that means that the owner of the business is going to be occupying that property, and they're going to have a vested interest in the continuation of their operating company. Compared to if we're working with somebody that's looking at an investment property, the tenant is at an arm's length. So they'll own the property, but they have tenants that occupy it. And so the financial performance of the tenants, the wherewithal of the tenants, is really the source of that repayment for the loan. And because it's at an arm's length, because the owner of the property doesn't own the business that's occupying that property, there's just that arm's length distance in the perceived risk associated to that. So that's why the loan to values are a little bit lower.
So if they're doing, so I had a client that purchased a gas station car wash, and we talked about they were doing SBA, so they were needing to get money for the remodel, right? The property needed work. And then also we talked about bringing in, has that percentage change, or what is that percentage if they bring in some tenants underneath them, like they contract with a coffee shop or a sandwich shop and they bring them in, so they're getting extra rent coming in, but they still have that SBA loan.
Yeah. What was the question again?
I thought was the owners having to be like 51% percentage of the property, and then how do you guys find that out? Has that percentage changed? And like let's say they purchase a big building and they're like, oh, I'm gonna do an executive suite, or what does that look like, right? How do you guys figure out the percentage? Or
Yep, great question. So specifically about that occupancy percentage rate, the 51% is a specific guideline for the SBA loans. The owner of the property has to occupy at least 51% of that. So they can have other tenants in the property that occupy the 49%. I'll also add that from an underwriting perspective, the SBA is only going to look at the cash flow for the 51% owner, the majority owner of that property, to support the loan. They won't take into account any rental income, because there's a greater risk of having the 49% occupants or occupant being able to leave the property. There is less of a tie that a tenant has for the property compared to the actual owner of the property. So that's where there's that difference for SBA lending. So then to maybe point out for your second question is, how do we figure out the occupancy? Is certainly having those conversations with the borrower, understanding what they're looking to achieve in the property. Are they looking to occupy the majority of it? Or are they looking for rental income to help support the loan? So if they are looking for rental income to help support the loan, that certainly doesn't qualify them for the SBA. So it would have to go conventional. And then it's really understanding and being able to talk to that borrower about, okay, if you're going to have tenants, then we're going to want you to have certain lease terms with those tenants. We're going to have certain documentation as part of the loan that's going to tie those rental payments to the loan repayment. Some other nuances will come in, but really it's about having that conversation with the borrower to understand what their intentions are with the property and determine what the best loan structure is and the requirements for that. So I hope that answers your question. So let's see. So again, I'll just do the basic analysis from an underwriting perspective to determine if it's a viable opportunity that we might have a successful outcome of an approval for. And with that information, I'll be able to issue a term sheet. I'll go into what is included in a term sheet. And it's really kind of at this stage in the conversation and the opportunity that a purchase agreement might come into the picture if it hasn't already. So with you as the agent, if you know that there is a general pre-qualification, and I'm going to clarify that in a second, that you're better positioned to be able to put in a letter of intent or even a purchase agreement on that property opportunity. And I want to make sure that I always tell customers, I mentioned that time frame earlier, 60 to 90 days. Additionally, you want to make sure that you consider having a financing contingency just in case the loan doesn't get approved, because even if a term sheet is issued, that isn't a guarantee of approval. So then what's next? I talked about, oops, sorry, if I can go back. I'm going to go back a screen. So with that term sheet that's issued, what I'll touch on is it's going to outline who the lender expects the borrower to be. It doesn't have to be known, especially if the company is going to create a new entity for the property ownership or something of that nature. It will include the loan amount, the loan to value that I mentioned, whether it's owner occupied, it could be upwards of 80% loan to value. If it's an investment real estate, it could be up to 70% loan to value. It's going to detail the interest rate, the proposed interest rate. Is going to detail the term, any repayment requirements, prepayment penalty. It'll detail the collateral, which is, of course, the real estate that's going to be purchased. It will also detail covenants. I'm going to talk about those a little bit later, as well as any additional information that would be required for formal underwriting. So it's going to be a really good tool for the borrower and for you as the agent to understand what type of financing structure is going to be used or going to be considered for that real estate purchase. And since we're on this topic, I did want to touch on interest rates. I know we talked about that at the beginning, Mara. Where interest rates are at right now and kind of where they have been. I mentioned I use the 5-year treasury. That's really a generally used baseline for banks to lend money against, and then they'll add a spread on top of that. So for example, the 5-year treasury, I think, is right around 3.52%. It's only been fluctuating a few basis points over the last few weeks. Prior to that, about 2 months ago, maybe 3 or 4 months ago, it was upwards of 3.75, even 4%. So in the last few months, I've seen the 5-year Treasury has decreased, and that was really done in the market as it was anticipated the Fed would cut rates as they did last week, which is good. That's going to be really good for our small business owners. That's going to be really good for our consumers, especially those that have lines of credit, credit cards, et cetera. So hopefully that trend will continue. So I mentioned the spread. Normally, I'm quoting an interest rate of the 5-year Treasury plus 300 basis points. So if the 5-year Treasury is at 352, that means the potential interest rate on a current loan today would be at 652. So my interest rates are probably ranging anywhere from 6% to 6.75% right now, which is down significantly from the last 12 months where I was upwards of 7.5, approaching 8. Thankfully, I never had to quote an 8% interest rate. Additionally,
I'm sorry. I'm like, that's just crazy because their price point is, it just really affects the economy, you know?
Yes,
So
completely. I'll switch to business lines of credit. Those generally range at prime plus 1 to 2%. So lines of credit for businesses were experiencing over 10%. Additionally, on the SBA side, the spread is usually 2.75%. This is in the 7A area. They're going to do the prime plus 2.75 all the way up to 4% for 7As. The 504 loans are going to be more comparable to slightly better than the conventional commercial real estate interest rates. So those right now are probably in the low 6s. They might even be in the upper 5s right now for an SBA 504 loan. So yes, heading in the right direction.
and
I also,
sorry, no, so lines of credit are super important for businesses. Like, so I came from construction background. My brother-in-law has a big general contracting firm, and that's when the housing market crashed, he lost all lines of credit, and it's a numbers game. How long can they keep their money in their accounts because they're making money off of that? But then they use the lines of credit when they haven't gotten paid from up above, right? To pay the subs. And it's a whole trickle effect. So, if you're not in that world, and I don't know I don't know the other businesses that utilize their line of credit fully, but um, and that really impacts a business owner. And if they're trying to grow, and I mean, not even talking about purchasing or selling, that right there can impact someone closing their doors. So,
yeah, absolutely. Talking about lines of credit for businesses might be another discussion opportunity in the future. But yeah,
I
I completely
agree.
agree with you.
And
Yeah,
investor, I definitely would like to do an investor loan class for,
sure.
yeah, I think that would be good.
Yeah, those are different. Absolutely. And I know I'll try to keep the content short, but lots can be talked about in regards to investment real estate as well. So at this point, the term sheet's been issued. Maybe the purchase agreement has been signed. And then if that is all acceptable to the parties, then we move forward to the next step in my world, and that is formal underwriting. So I just wanted to share a little bit of insight on the formal underwriting. I know this isn't talked about a lot, but I thought it might be helpful just to touch on what I look at as an underwriter on a commercial real estate loan. So with regard to the formal underwriting process, of course, at this point, I've gathered the bulk of that financial information. Maybe there's some additional information I'll still need, certainly additional questions, but there's really 3 points that I'm driving for at this stage. And that's the sources of repayment for the loan. It's not just one source of repayment. I actually have to underwrite and look at 3 different sources of repayment. The first and primary source is going to be the cash flow. So if we have that business owner that's looking to move from a leased space into actually owning their real estate, I'm going to look at the cash flow for that operating entity as being my source of repayment for the loan. Additionally, if I wanted to mention global cash flow, where that usually shows up is if I'm dealing with a professional services business, for example, an attorney. There are certain businesses, certain industries that will distribute profitability from the business to the owners. And so in those cases, it's really a shared cash flow between the business as well as the owner. But I do have the ability to be able to underwrite from a global cash flow perspective versus just the business because of those distributions that are considered in the underwriting. And the third cash flow would relate to those investment real estate purchases, the rental income from the property, be it one tenant, be it multiple tenants, et cetera. We're looking at the net operating income from those rents received, of course, taking into account any expenses for the property itself. So that's the first source of repayment. Additionally, we look at the collateral as a source of repayment. I'll go into a little more detail in a slide or two. And then the third source of repayment that I'm underwriting is going to be the guarantor, the business owner, any owner of the borrowing entity. I'm going to take a look at their cash flow, their personal wealth, their wherewithal for their ability to repay a business loan. So I'm really looking at those three sources of repayment to determine which ones are strong. Are there any weaknesses in there? And a multitude of other things. So I just wanted to touch on those. So this is the primary source of repayment, that cash flow. This is actually a calculation. There's two things that I love in what I do. Number one, I love numbers. Numbers for me tell a story. And so I get to analyze the financial information. I really do geek out about the numbers to try and figure out what is the story that these financial statements are trying to tell me. The story that they're trying to tell me is the business decisions that have been made over time. They're telling me what some of the goals are for that business owner and what they're trying to achieve with their business. Additionally, I like the customer service aspect. So I really love having the conversations with business owners to understand where they've been, where they are today, and where they want to go, and finding ways to help them achieve those goals, or even make corrections in their business decisions, help them think about what are some really important things to help their business be successful. What are some important things to help them if leaving a legacy with their business, or helping their family thrive, create generational wealth, and then everything in between. So with regard to that cash flow, I just wanted you to see that there is a calculation behind it. There is some math behind it, but there's also an opportunity to be really creative and understand, are there certain expenses that the business owner had to make a decision about that I can add back to cash flow that are considered one-time expenses? So there's really some creative underwriting that can happen as well. I mentioned the global cash flow process. That's really just the marriage between the business cash flow as well as the personal cash flow. And then the rental income for an investment property, just what that calculation looks like. So again, just wanted you to see that. Any questions so far? Okay. Let's see. We're still doing good on time, thankfully. So the secondary source of repayment is that collateral. When a term sheet is accepted and we go into formal underwriting, a big part that has to happen and should happen is actually getting the appraisal. And I want to mention that it's really important to know that the bank is the one that should actually engage the appraiser in the appraisal process versus, for example, the borrower or the client engaging that appraisal. The reason is because from a regulatory perspective, it's really important that the bank manages that process versus the borrower or the individual. There is a perceived risk associated to, or an influence associated to anyone but the bank ordering that appraisal. So that's a really important aspect. So the appraisal is going to really be the gauge and substance of information as it relates to that collateral, what the value is and what the basis is from an income perspective, a sales comparable perspective. More often than not, the cost perspective isn't used in an appraisal. And I might pause here for a second because I know that appraisals in the residential space are going to be different than they are in the commercial space, simply in size and content and the time frame involved. Typically, a commercial appraisal will take on average 2 to 3 weeks. If we're in an economy where things are really, really heavy, there's a lot of activity, and thankfully we've had those. It hasn't been that way for the last several months, but the time frame for an appraisal has extended to 4 to 6 weeks. In my past experience, right now we're sticking to that 2 to 3 week time frame. So I think residential appraisals, that might take a matter of days, possibly, if that's right. So again, that's going to be the bulk of the information that I'm looking for to determine the value of the real estate. Again, Mara, that's a whole other topic that could be talked about, is what's involved in a commercial real estate appraisal.
I think that would be a really good one.
Yeah.
So you have 3 classes already.
Although I'm not the expert on the appraisals.
No, but you could bring one in. I think that
Yeah.
would be really good to hear. We did a commercial inspection, so
Yeah.
I think, yeah.
Yeah. And, again, there's so many similarities between residential and commercial, and yet there's still so many differences too. Let's see. So, and I think I already talked about the owner occupied property does have a perceived lower risk associated to it. Again, because the business is operating out of that property, they want to stay in that property. They want to continue business. Whereas investment real estate, when you have tenants, the tenants are perceived to be not less reliable, but they have greater ability to say, I can't afford to stay here anymore. I'm going to have to close my doors, or I'm going to have to move, or something of that nature. So that's why there is a difference in the loan to value threshold. So again, I didn't want to dive too deep on that secondary source of repayment. Finally, the third source, the tertiary source of repayment, is the guarantor. What I'm really looking at is, what are their liquid assets? What is their personal cash wherewithal? Do they have any cash value of life insurance? Do they have a stock portfolio? What are the assets that they hold as individuals that could be relied upon should the first source of repayment, cash flow from the business or cash flow from the tenants, be compromised? Should the secondary source of repayment, the collateral, should there be a market condition that shifted the value in that real estate? What does the guarantor have in their personal resources to be a source of repayment on the loan? Additionally, with regard to net worth, what is their net worth comprised of? Do they own other real estate? Is there equity in the other real estate? So I'm considering all of those factors. Additionally, what is their personal cash flow for their household? What does that look like, and what can be relied upon if that source of repayment is needed to repay the loan? So again, just really wanted to kind of scratch the surface on some of those underwriting pieces. A lot more goes into the underwriting of a loan. And I realize in this part of the conversation, I haven't talked about the timeline for underwriting. Generally speaking, as long as all the parties are responsive and providing answers to questions, providing information that was requested, a typical timeline can be 1 to 2 weeks. That is elongated if there are any issues in gathering information, if there's any issues or concerns about the property itself, et cetera. So I just wanted to touch on that. The formal underwriting process can take 1 to 2 weeks. Additionally, there is an approval process for many banks. So I myself work with a loan committee. And so I have to present the loan request to loan committee. They make the decision to approve or deny. And then sometimes banks have a second loan committee, which is what I have, depending on the size of the deal. So it's really important for a borrower to understand and have open communication with their lender about what's expected, who's doing what and when, what does the timeline look like so that everybody is in the know and kind of understands what the next step is. So with that, then hopefully you get to the point that the borrower has a loan approved. That doesn't mean that the process ends and the box is wrapped up with a nice bow. There's still more work that has to be done. And so what happens next for me, once I get that loan approval, is I will extend a commitment letter. So this is going to be a conditional approval. So it's a step better than a term sheet. The loan's been approved, and there's conditions that are precedent to closing. There's conditions that have to be met so that the loan can close. If the appraisal hadn't been obtained yet, that's usually ordered at this stage. Any title work that needs to be done, that's also usually engaged at this stage. If there's a phase one that's required, sometimes that's done during underwriting, but sometimes that's also done at the stage where the loan is approved. And then any other required documentation to get the loan to closing. The time frame for this can generally range from 2 to 4 weeks. So if you look back at that original time frame of 60 days, best case scenario, that is all encompassing from the first time that the borrower might engage with the bank, to the preliminary underwriting and the issuance of the term sheet, to the formal underwriting, as well as the loan closing. There's lots of parties involved: the borrower, the bank, the title company, the appraiser. If there's an environmental requirement for that phase one, and potentially other individuals, say, for example, an attorney, if attorney documents are required. Most banks don't prefer to do attorney required documents, but there are certain situations that would require that, be it the bank requiring it or even the borrower requiring it. That typically is done based on complexity of the project. So I think that covers the phase of the 2 to 4 week time frame to get the loan to close. And I think I've only got a couple of more slides here. There we go. Oh, sorry, I got click happy. Let's see. Okay, so now it's a race to the closing and what could go wrong. I'll give you an example. I had a loan that I did earlier this year. Through the title commitment process, it was uncovered that the title company required a survey. This happened to be on a recently constructed property. The survey hadn't been updated. And so our closing timeframe was extended by an additional 2 weeks because the title company required a survey. So it can, in this phase, lots of things can go wrong and nothing can go wrong. And what's really important is just to make sure that all the parties are communicating, asking questions if necessary. So in the end, everybody wants the loan to close. It generally always gets done 99.9% of the time. And so I hope with all of that, I was able to at least scratch the surface on commercial real estate lending, and provide a little insight, but looks like we still have some time for some questions.
Do you guys have questions?
None from me.
Christy, this is awesome.
Good.
What about, I guess we could go in like big projects. Have you loaned on apartment complexes or hotels, or give us some ideas of other clients?
Yeah, absolutely.
Churches, or, yeah.
Sure. So what have we lent on? So yes, we have done loans for hotels, and I think the majority of those have been ground up construction, so brand new hotels. Apartment complexes, we have done multifamily apartment complexes. I think that space is probably a little bit more existing properties that have been purchased or even refinanced, probably a little less on the ground up construction. Owner occupied properties, the majority of my owner occupied properties have tended, especially here in Arizona, have tended to be SBA 504 loans, simply because of the 2 points, the slightly better interest rates. And I'll highlight this. 504 loans have the ability to, for the SBA portion, I'm going to break this down. 10% equity from the borrower, 50% loan from the bank, 40% loan from the actual SBA. It's facilitated by a local CDC, a Certified Development Corporation. I think we have 3 in the metro area. So there's that 10, 50, 40 split. The 40% SBA loan, the interest rate is actually fixed for the full 25 years. The 50% bank loan, that's the same structure that I mentioned on the conventional lending side. It's going to be a 10-year term based on a 25-year amortization, but we're also going to reset the interest rate 5 years in. So the interest rate for the bank portion is going to be fixed for 5 years, but the SBA portion is going to be fixed for the full 25 years. So I wanted to mention that about SBA 504 loans. Again, the owner occupied properties that I do, it's such a beneficial structure that it usually makes the most sense. Whereas a conventional loan, I'm going to require, 20, 30% down. Again, I'm going to fix the interest rate for 5 years. What other lending do we do in real estate? Certainly investment properties. I'll give you an example. One that I'm currently working on, just issued a term sheet last week. It's a property in Mesa. I believe there are 9 tenants currently, but they're 83% occupied. So they have 5 or 6 spaces that they can still lease out. That's a well-established property. It's actually a purchase. So our borrower is going to be purchasing that property from the current owner. So as part of the underwriting, I'm taking a look at the tenant mix. So I do research on who the tenants are, how long they've been in business. Additionally, this is a point I didn't mention, especially for anchor tenants or those tenants that occupy a larger portion of that investment property. I'm going to be asking for financial information. So I'm going to be underwriting those larger tenants as well. Industry-wise, it really is universal. So we have done gas stations, large office complexes, like for example, maybe a medical facility where they've got a bunch of medical offices, a bunch of medical tenants, professional services, attorneys, that kind of thing. I have another customer that's a law firm. They've expanded in their building to, I think, a total of 6 different suites that they've purchased over the last several years. I'm trying to think of other real estate loans that we've done. Single tenant, owner occupied, I mentioned I do a lot in the business owner currently leases space, and now they want to get into ownership. I've been able to transition a lot of those customers into ownership as well. Again, those are primarily the 504 loans that I've done for them.
That's
Does
awesome.
that kind of help?
Yeah. Yeah. No one else has any questions?
It's a lot to take
It's
in.
good. Yeah, it is. It's a lot. I definitely will email you and follow up with some additional classes I think will be really good. And just, I think you worked with Sean Brown, correct? One of our agents.
Not directly, but yes,
Oh,
I know
okay.
Sean. We
Yeah,
haven't done
you know
anything
him.
specifically. Yeah,
Okay. Okay, he's awesome. Yeah.
he is. Yep.
Yeah. Cool. Okay.
Yeah.
Well, I
And
appreciate your time. Sorry, go ahead.
no, I was just going to say, I am certainly available for any conversation.
Okay.
Helping people navigate banking not
Yeah.
only on the lending side, but the deposit side, but especially the lending side, just because that's what I primarily do every day. Just helping people understand what their options are, helping people understand what the process is, what they should expect from their lender. I
Hmm.
have lots of conversations with people that they call me and say, "Hey, I'm working with Wells Fargo and this isn't making sense to me. Can you help me understand?" Absolutely. You're already through the process with them. If I can just help you understand what stage you're at and what you can expect next, I have lots of conversations like that. So always happy to help.
Well, I think you're probably the same as, residential. We're like, don't go to your bank for a residential loan. And a lot of people just start with their bank and they don't have, typically they don't have experience or they're not good at it.
Yeah.
So I wouldn't, I wouldn't trust Wells Fargo or Chase or I just wouldn't,
They
but
there are challenges with every bank. So by no means is my process perfect. We generally take a little bit longer than others. There's nuances to it all, but at least my understanding in my history of banking and finance is understanding how the national banks operate, what their
yeah.
process is, along with my process, and just helping people understand what is best for them, what's going to work best for what their needs are.
Okay. Awesome. Well, I'll shoot you an email. I really
Sounds
appreciate
good.
your time. Um,
Yeah.
truly, and we have you listed under one of our vendors. So
Well, thank
so
you.
hopefully you'll hear from our agent. So
Good. Well, I
yeah,
appreciate the opportunity very
yeah.
much. Thank
Thank
you.
you. All right.
Okay.
Thank you,
Take
everyone.
care.
Okay.
Bye.
Bye.